Hi, welcome to the Dutch Value Investor channel, the channel where I help you find the best value stocks to put on your watch list. In today's video, I will have a look at PayPal and give you an analysis of the strength of the business, the strength of the management, and the calculation of the intrinsic value of the company stock. For a full tutorial on how to value a company, watch this video first. So without further ado, let's have a look at the business. For a company to keep being relevant and maintaining a growth trajectory for the medium to long-term future, it needs some kind of competitive advantage or so-called moat that protects the company from competitors taking over the business. In order to confirm the presence of a moat, you are looking for companies that have a minimal average growth of 10% compounded per year for at least the last 5 to 10 years for the following metrics. The first being equity growth. Second, earnings per share growth. Third, operational cash flow growth, and fourth, revenue growth. So looking at the growth rates of PayPal, equity growth comes in at 4.86%. Earnings per share growth is 7.29%. Cash from operating activities growth is 18.09%, and finally revenue growth comes in at 16.01% compounded over the last 5 years, giving PayPal an average moat growth of 11.56% compounded over the last 5 years, nicely above the preferred 10%. It looks like PayPal has a moat based on these numbers, so you can probably assume a healthy growth rate can be maintained for the medium to long-term future. Next, let's have a look at PayPal's management. For a good long-term investment, it is essential that a company has efficient, capable, and shareholder-friendly management. In order to evaluate the efficiency and quality of the management, there are some key indicators to look out for. Number 1. Return on invested capital, meaning what is the rate of return on the money being invested into the company. Looking at the return on invested capital, PayPal's management was able to maintain an average return on invested capital of 13.08% for the last 5 years, nicely above the preferred 10%, and this is an indication that management allocates its money effectively. Number 2. Long-term debt versus free cash flow. It is hard for a business to go bankrupt if they have no debt, so no debt is ideal. High debt can become a real problem in the future, but a little debt is not a problem as long as it can be paid off quite easily, preferably within 3 years using free cash flow. PayPal has a long-term debt of $10,417 million and an average free cash flow over the last 3 years of $5,176 million. So management can pay off long-term debt within 2.01 years using their free cash flow if current free cash flow levels can be maintained. And finally, number 3. Outstanding shares, and especially the dilution of outstanding shares. This metric gives you an idea of how the CEO is treating the company's shareholders. Share dilution can be a silent killer and can greatly reduce your overall results. For PayPal, looking at the last 5 years, management has been buying back its own shares at a 1.12% compounding rate. This is good, as long as they buy them at the appropriate moments. Please leave a like or comment if this video helped you, I'd really appreciate it. And consider subscribing if you like to see more stock analysis videos. Now, let's get to the calculation of the intrinsic value. There are 2 ways to determine the intrinsic value of a company, either through their earnings or their free cash flow. Both methods can be used separately, but it is even better when they are used together to get an even clearer image of the true intrinsic value. First, let's start with the intrinsic value based on earnings. For this calculation, you need the following 4 numbers: trailing 12 months or 3-year average earnings per share, future growth rate, future price per earnings, and required rate of return. The 3-year average earnings per share for PayPal is $3.05 per share. For PayPal, I assume the projected compounded annual growth rate to be 13.78%. This is the average of the moat growth and analyst growth rate. For future price per earnings, I will use a PE ratio that is appropriate for the growth rate. I always verify if this PE is reasonable and historically accurate. Meaning, has the stock been trading at or above this PE level for a considerable amount of time in the past? Finally, the required rate of return. Taking into consideration that the average rate of return on the S&P 500 for the last 20 years is around 10%. You probably want to increase this return to at least 12.5 to 15% to make it worth investing in individual stocks and to create a margin of safety. Using the following formula, I believe today's intrinsic or fair value of PayPal is around $56 to $62 per share based on earnings. Now let's see what the intrinsic value of PayPal is based on the free cash flow the business generates. For this calculation, you take either the trailing 12 months or the 3-year average free cash flow and you grow this free cash flow with the same growth rate as the earnings for the next 8 years. 8 years is used because this is the approximate time frame an average investor seeks to earn back his initial investment. You add up these free cash flows and add the equity which can be found on the balance sheet. You divide the outcome by the number of outstanding shares and end up with an intrinsic value per share of $86. Now, does this mean you start buying this company as soon as the price hits these levels? No. Just put the stock on your watch list, build your own story around the company, get confident with the financials and future outlooks. Because only if you're confident with your own story you will be able to make rational decisions while markets fluctuate. Consider subscribing if you like to get a new stock analysis as soon as possible. Also, check out these videos for some great companies that might be interesting for you to put on your watch list. Thanks for watching and see you in the next video.